You probably already know that house hacking is the smartest way to buy a home. And you've probably heard that there are tax benefits to house hacking as well. In this video, we're digging into the 6 big tax saving strategies available to house hackers, which can result in tax-free rental income and even a tax-free sale of the property when you're ready to exit. Whether you're currently house hacking or still doing your research, this is wealth building knowledge you don't want to skip. I'm John Schwartz, a house hacker and realtor in Los Angeles, California, and this channel focuses on fact-based, data-driven strategies for hacking any housing market. Please subscribe for more videos like this one out every Tuesday. And I should probably point out here that I am not a CPA and this video does not constitute tax advice. I'm but a layman speaking from my own experience and research, and you should definitely consult with a CPA before pursuing any of the strategies discussed in this video. That said, let's dive in. Now, before we get into the 6 big tax saving strategies, we have to understand the principle that underpins all of them. When you house hack a multifamily property, the IRS regards your unit as your primary residence and the rest as an investment property. The IRS will look at square footage to determine what percentage of the property is personal residence versus investment property. For this video, we're going to simplify the math and consider a duplex with equally sized units. That's the kind of house hack I live in. In this case, the property is 50% primary residence and 50% investment property. Okay, let's get into it. House hacker tax saving strategy number 1. Writing off expenses. Because part of your house hack is regarded as an investment property, you can deduct all expenses associated with that part of the property. Any expenses associated specifically with the rental units are fully deductible, and any expenses for the property as a whole are deductible in proportion to the rental unit square footage. So to use our easy example again, if you have a duplex that's half primary residence and half investment property, any expenses for the property as a whole would be 50% deductible. Those are the basic rules. How you use them to your advantage is only limited by your cleverness. For example, my wife's grandfather owned a Chevy dealership in Pennsylvania, so my father-in-law grew up washing cars. He's a pro, and he's instilled in me a real pride in cleaning my car, which I do every couple of weekends with the help of a fancy pressure washer for the exterior and a shop vac for the interior. Now the shop vac was purchased when my tenants asked that I sand down the corner of a door to keep it from getting stuck in the door frame. Did I really need a $100 shop vac to clean up 5 minutes worth of sanding? Yes, I did. Not that the IRS is ever going to ask. Full deduction. And the pressure washer was purchased to keep my duplex's exterior clean. I still have that task on my to-do list, so the purchase was in perfectly good faith. 50% deduction. You won't be able to use these full and partial expense deductions to buy anything you want, but you will be able to get a good discount on anything to do with landscaping, all exterior maintenance, and pretty much anything you'd buy at a hardware store. If you have any smart ideas for expensing, let me know in the comments. Okay, house hacker tax saving strategy number 2. Taking a portion of your property taxes as a business deduction. If you own property, you have to pay property taxes every year, and this tax is levied by your county, meaning it's a local tax. Now, the IRS allows you to deduct local taxes from your federal taxes. It's called the SALT deduction, SALT being an acronym for state and local taxes. However, the SALT deduction is capped at $10,000. If you live in a high property tax state, like Texas or Illinois, or a state that has high state income taxes like California or Oregon, or a state that has both high property taxes and high state income taxes, I'm looking at you, New Jersey, you're going to hit the $10,000 SALT deduction cap by owning even a median priced home. However, if you're house hacking, a portion of your home is an investment property, meaning a portion of your property tax is a deductible business expense with no deduction cap. Using our duplex example again, 50% of the property taxes can be taken as a business expense and deducted without any cap. The other 50% of the property tax bill will then be applied towards your SALT deduction cap. This will allow you to fully deduct your property taxes and still have room in the $10,000 cap to deduct some state income taxes if you have any. As a Californian, I certainly do. Honestly, it seems like half of smart tax planning is finding workarounds for deduction caps. With that thought in mind, house hacker tax saving strategy number 3. Taking a portion of your mortgage interest payments as a business expense. So this strategy is very similar to the previous one, but it's a workaround for a different cap. If you have a loan on your primary residence and you pay interest on that loan, you're allowed to deduct your interest payments on up to $750,000 of borrowed money. For most homeowners in America, this cap is generous enough that it allows for all of their mortgage interest to be deducted. So long as you didn't borrow more than $750,000 to buy your house, you can deduct all of your mortgage interest. However, in more expensive markets, like mine, this cap is pretty easily met. I believe the smallest loan that a client of mine took this year was a little over $820,000. The loan I personally have on my duplex currently has a balance just north of $1.3 million. So once again, the workaround is to take a portion of your mortgage interest payments as a business expense. Because a portion of your house hack is an investment property, you can take the proportional amount of your mortgage interest payments and deduct it as a business expense. For me, this is huge. I take the interest on the first $650,000 of my loan as a business expense tied to my rental unit, and the interest on the remaining $650,000 of my loan as a personal deduction. In my case, is a savings of around $15,000 per year. That's meaningful, and it'd be very meaningful to me if you'd give this video a like. It helps grow the channel, and I appreciate it. Moving on. House hacker tax saving strategy number 4. Taking depreciation. Real estate depreciation is a huge topic that warrants its own video, so for the purpose of this video, I'm just going to cover the basics. Even though most real estate in America appreciates in value over time, in the eyes of the IRS, investment property depreciates over time as though it were a piece of business equipment. Crazy, right? In fact, the IRS has determined that the lifespan of a residential rental unit is 27.5 years. The IRS has decided that over 27.5 years, the value of your rental units will decrease from whatever you paid for them to 0. And you are actually required to deduct this hypothetical loss, referred to as a paper loss, every year. So every year from your rental income, you deduct 1/27.5 of the value of the building. That comes out to about 3.6%. Every year, you deduct from your rental earnings about 3.6% of the value of the building. Now, there are a lot of details behind this. Depreciation occurs only to buildings and improvements like driveways and fences, not to land. And you can only depreciate the portion of your house hack that is considered an investment property. Still, for a $400,000 duplex, that's maybe a $3,500 deduction you get to take every year. Also, depreciation deductions are a deferral of taxes, not an exemption. Way down the line when you sell the property, you do have to account for depreciation deductions through what's called depreciation recapture. We're now way above my pay grade, but long story short, if you have to pay a tax, it's better to pay it in the future than now. And that's what depreciation lets you do. And you can supercharge the power of depreciation to get tax-free rental income with House Hacker tax saving strategy number 5, doing a cost segregation analysis. Okay, this is some next level ninja shit, and I'm definitely recording a whole video on the cost seg analysis. As soon as I do, I'll link to it up there. If there's no link yet, I haven't made the video yet. Here's the quick explainer. As previously discussed, the IRS has decided that a residential building loses its value over 27.5 years. But that's not the full story. The IRS has actually gone further and specified that some parts of the building lose value faster. So according to the IRS, site improvements, which means landscaping, fencing, walkways, etc., lose value over 15 years. Telephone wiring loses value over 7 years, and some replaceable elements like electrical outlets, decorative lighting fixtures, cabinetry, carpeting lose value over 5 years. If you can identify what parts of your building fall into these faster depreciation buckets, you can take that depreciation faster. What's more, the 2017 tax bill introduced bonus depreciation, which allows you to take the totals from your faster buckets, multiply those amounts by 150 or 200%, and then take all of that depreciation immediately in year 1 of ownership. The bottom line is that when you house hack, from the rental portion of your property, you can immediately create a bonus depreciation deduction to completely offset at least a year of rental income, if not 2 or 3. That's right, losses from depreciation carry forward into subsequent years if you don't have enough rental income to account for all the deductions you've racked up. Just as an example, in 2021, I earned $49,750 of rental income from my house hack. Because of the bonus depreciation I took on my 2019 tax return, I will pay 0 in taxes on that $49,750 of income. It's ridiculous. There are more details to this, and the key is hiring the right analyst to perform a logarithmic cost segregation analysis. I'll be making a full explainer video and linking it above as soon as it's done. In the meantime, throw any questions you have into the comments and I'll answer there. All right, finally, House Hacker tax saving strategy number 6. Paying 0 in taxes when you sell. Regular homeowners and real estate investors each have tax saving strategies upon the sale of their property. And as a house hacker, you can take advantage of both. Let's use our simple duplex example again. Half the property is primary residence. So when you sell, half of your profits are shielded from capital gains taxes up to $250,000 for a single person or $500,000 for a married couple. The other half of the property is an investment property. So when you sell, you can take advantage of the 1031 like-kind exchange to reinvest the other half of your profits tax-free into another investment property. Like depreciation deductions, the 1031 exchange is a tax deferral. But again, it's better to have your money to reinvest now and pay taxes later. I'm not a CPA, but as a layman, here's how I plan to use this tax-saving strategy in my own journey. I live with my wife and 4-year-old daughter in a pretty expensive duplex in a beautiful neighborhood of Los Angeles. We bought the property in 2019 and completely renovated it, including adding a bedroom and a bathroom. Thanks to that, and the pandemic, I now have a ton of equity in my house hack. Too much equity, perhaps. So, while our original intention was to hold this duplex forever, now I'm thinking we might sell it in another year or two when we move out. My plan is to reinvest half our proceeds, tax-free, into another investment property via a 1031 exchange. I'm eyeballing Inglewood and South Los Angeles, neighborhoods that are amazing for investment, but for a myriad of reasons, not great for house hacking. I'll get more return on my equity by moving it into one of these markets. With the other half of the proceeds, we'll take the homeowner's capital gains exemption. We'll have a couple $100,000, tax-free, to put into our forever home. My wife's already browsing Redfin. Subscribe for more in-depth videos like this one, out every Tuesday. See you next week.